Good day to everyone. This is Dr. Nitya and I am here to deliver a lecture on financial management. We shall see the meaning of financial management, definition, objectives, functions of financial management and the sources of finance. Now, meaning of financial management. Financial management is that managerial activity which is concerned with the planning and controlling of the firm's financial resources. So in other words, it is concerned with acquiring, financing and managing the assets to accomplish the overall goal of a business enterprises, that is to maximize the shareholders' wealth. In a layman term, we can put up financial management as managing the finance or managing the funds or managing the money. Now to definitions of financial management. So, according to Solomon, financial management is concerned with the efficient use of economic resources. And according to Philippatus, financial management is concerned with management decisions that result in acquisition and financing of long-term and the short-term credits for the firm. So, financial management deals with the selection of specific assets, or it may be the combination of assets and their effective use. The analysis of these decisions is based on expected inflows and outflows of funds and their effect on the managerial objectives. Now, to the basic objectives or aspects of financial management. It is not objectives, it is aspects. So, basic aspects of financial management. There are two basic aspects of financial management. One is procurement of funds and the other one is the utilization of funds. So, what is procurement of funds? Getting the funds. From where does the company gets the funds? So, the funds can be classified into own funds and the borrowed funds. Own funds will be called as equity share capital, and the borrowed funds, the examples may be debentures and the long-term loans. So, while speaking about the procurement of fund, we have to see the characteristics of the sources of funds. There are three characteristics of sources of funds, which is called as risk, cost and control. Now, we shall see one by one. So, high risk goes to which fund? Own fund or borrowed fund? So, the high risk goes to borrowed fund. The fund raised by the issue of equity share capital are the best from risk point of view for the firm, since there is no question of repayment of equity capital except in the period of winding up. But the borrowed capital, the interest has to be paid and the principal amount has to be paid on time. So, high risk goes to borrowed fund. Then, high cost. High cost goes to which fund? Own fund or borrowed fund? So, from the cost point of view, equity share capital is most expensive than the borrowed fund. This is because the dividend expectations of the shareholders is always higher than the interest expectation of the debenture holders, and the interest the company pays is free from taxes, unlike the dividend payment which is made from the taxed profit. Okay. Next, high control goes to which fund? Own fund or borrowed fund? So, high control goes to borrowed fund. A company can have control only on the borrowed funds and not on the own funds. Only the shareholders can have control on the company and not the company on the shareholders. So, high control always goes to the borrowed fund. So, these are the characteristics of sources of funds. So, when the finance manager decides on the sources of funds, he has to look into all these three characteristics. Now, we shall see into the other basic aspects, which is called as effective utilization of funds. The finance manager is also responsible for the effective utilization of funds. He has to point out situations where the funds are kept idle or where proper use of funds is not being made. So, if the funds are not utilized properly, the cost of procuring them will be higher than they generate income. Hence, it is crucial to employ the funds profitably and properly. So, the funds utilized is used to procure the fixed assets. The funds are to be invested in fixed assets in a manner so that the company can produce at its optimum level without endangering its financial solvency. Then utilization of working capital. The finance manager should also keep in mind the adequate requirement of the working capital needed to run the business. So these are the basic aspects of the financial management. The first one is procurement of fund and the other one is the utilization of funds. Now let us see the objectives of financial management. The first one is the profit maximization goal. The primary objective of a company is to earn profit as per the traditional approach. This implies that the financial manager should take decisions which will increase the profits of the firm, and he should not take decisions which will decrease the profit of the firm. However, profit maximization cannot be given undue importance. Why? It has some disadvantages. We will see one by one. The first one is the term profit itself is a vague thing. It is not explained properly. The profit may be a long-term profit or a short-term profit or total profit, or it may be a rate of profit which is not explained clearly. Then the second point, profit maximization has to be attempted with the realization of risks involved. If profit maximization is the only goal, then risk factor is altogether ignored. The third point, profit maximization as an objective does not take into account the time pattern of returns. If the profit maximization is only goal, then the time pattern of returns is also totally ignored. Then the profit maximization as an objective is too narrow. It fails to take into consideration the other stakeholders, which are workers, consumers, and society. So there are these are the disadvantages in the profit maximization goal. So the next basic objective is shareholders' wealth maximization. The shareholders' value maximization model holds that primary goal of a firm is to maximize the market value of the firm, and implies that business decisions should seek to increase the net present value of the firm. So for measuring and maximizing the shareholders' wealth, finance manager should follow the 3 points. The one is he should follow cash flow approach and he should avoid accounting profit. Then he should do cost benefit analysis and he has to apply the time value of money. So these 3 points are very much important for a firm. Next, we shall see the functions of financial management. So, what are the functions of financial management? We can term it as long-term finance functions decisions and short-term finance function decisions. In long-term finance function decision, we have investment decisions, financing decisions, and dividend decisions. We shall see one by one. So, investment decision. These decisions relate to the selection of assets in which funds will be invested by a firm. So funds procured from the different sources has to be invested in various kinds of assets. So the long-term funds are used in a project for various fixed assets and also for the current assets. The investment of funds in a project has to be made after very careful assessment or careful analysis of various projects through a technique called capital budgeting. So a part of long-term fund is also to be kept for financing the permanent working capital requirement. Next is the financing decision. These decisions relate to acquiring the optimum finance to meet the financial objectives and seeing that fixed and the working capital are effectively managed. The finance manager needs to possess a good knowledge of the sources of the available funds and their respective cost, and needs to ensure that the company has a sound capital structure. So what is sound capital structure? A proper balance between debt and equity. A company should always have a proper balance between debt and equity. So the finance manager should see to it that the cost does not exceed the assets. The financing decision also calls for a good knowledge of evaluation of risk. So the next decision is the dividend decision. So these decisions relate to the determination as to how much the firm has to retain as retained earnings and how much the firm is going to pay to the shareholders or the owners of the company. The owner of any profit-making organization looks for reward for his investment in two ways: the growth of the capital invested and the cash paid out as income. So for a sole trader, this income would be termed as drawings, and for a limited liability company, it is termed as a dividend. So next decision will be short-term finance function decision. So while deciding the working capital management also has to be decided by the finance manager. So short-term decisions are reduced to management of current assets and current liabilities, which is called as working capital. Now we shall see the different sources of funds or different types of funds. So we have long-term sources of funds, medium-term sources, and the short-term sources. So what are the meaning of long-term, medium-term, and the short-term? Long-term financial needs. Such needs generally refer to those requirements of funds which are for a period exceeding 5 to 10 years. All investments in plant, that is fixed assets, in plant, machinery, land and buildings are considered as long-term financial needs. Funds required to finance for the permanent working capital should be procured from the long-term financial sources. Permanent working capital, each firm requires a permanent working capital. That fund has to be procured from the long-term finance sources. Then medium-term financial needs. These requirements refer to those funds which are required for a period exceeding 1 year but not exceeding 5 years. So, if a company resorts for the extensive publicity and advertisement campaign, then such type of expenses may be written off over a period of 3 to 5 years. Those expenses will be called as deferred revenue expenses. Then, what is short-term finance? Such types of financial need arises to finance current assets such as stock, debtors, cash, etc. Investment in these assets are known as meeting of working capital requirements of a concern. The period will be 1 year. The main characteristics of short-term financial needs is that they arise for a very short period of time, not exceeding an accounting period, that is 1 year. Now, we shall see the classification of the sources of the funds. So sources of long-term and medium-term finance, it is equity shares. First one, we shall see the equity shares. So a public limited company may raise funds from the promoters, or it can raise funds by issuing of shares. That is ordinary equity shares. So it is a permanent source of capital for a company. The holder of these share capital, they will be called as the owners of the company. Equity shareholders are practically owners of the company as they undertake higher risk. So equity share capital shareholders are entitled to dividends after income claim of other stakeholders are satisfied. So the dividend payable to the equity shareholders is an appropriation of profit and not the charge against profit. So in the event of winding up, the equity shareholders can exercise their claim on their asset after the claims of other suppliers of capital have been met. So the cost of ordinary shares is usually high. This is due to the fact that the shareholders expect a higher rate of return because the risk is also higher for them. Then the ordinary share capital also provides a security to those suppliers of funds. Any institutions wishing to give loan to the company would make sure that the debt equity ratio of a company is comfortable to cover the debt. So it is like equity share capital is like a security. Now, next we shall go to the preference share capital. So, what is the difference between equity shares and the preference shares? These are special kind of shares. The holder of such shares enjoy priority both regarding the payment of fixed amount of dividend and also towards repayment of capital on the winding up of the company. So what are the characteristics of preference shares? Long-term funds from preference shares can be raised through the public issue of such shares. Such shares are normally cumulative. What is cumulative? The dividend payable in a year of loss gets carried over to the next year till there are adequate profit to pay the cumulative dividends. The rate of dividend on the preference shares is normally higher than the rate of interest on the debentures. Most of the preference shares these days carry a stipulation of period and the funds have to be repaid at the end of that stipulated period. The preference share capital is a hybrid form. Why it is called as hybrid form? Because it imbibes the characteristics of both of equity capital and the debt capital. It is similar to equity capital because preference dividend, like equity dividend, is not a tax deductible payment. It is paid after the tax is paid. So it resembles debt capital because the rate of preference dividend is always fixed. So cumulative convertible preference shares may also be offered, under which the shares would be converted into shares after the stipulated time. So the preference share capital may be redeemed at a pre-decided future date or at an early stage inter alia out of the profits of the company. Now, the next source of long-term finance would be retained earnings. So what is retained earnings? The long-term funds may also be provided by accumulating the profits of the company and by plowing them back into the business. Such funds belong to the ordinary shareholders and increase the net worth of the company. A public limited company may plow back a reasonable amount of profit every year, keeping in view the legal requirements in this regard and also for its own expansion plans. So such funds have no risk. So it is the retained earnings of the company which is set aside from the profits earned by the company. So next is debentures. So what are debentures? This is the loans can be raised from the public by issuing debentures or bonds by the public limited companies. So debentures are normally issued in different denominations ranging from ₹100 to ₹1000 and carry different rate of interest. Normally, debentures are issued on the basis of debenture trust deed, which lists the terms and conditions on which the debentures are floated. Next, the debentures are basically instruments for raising long-term debt capital. Debentures may be either secured or it can be unsecured. They may be listed or unlisted in the stock exchange. The cost of capital raised through debentures is quite low, since the interest payable on the debentures can be charged as expenses before tax. From the investor's point of view, debentures offers a more attractive prospect than the preference shares, since interest on debentures is payable whether or not the company earns a profit or incurs a loss. So the next long-term source would be bonds. Bonds are the fixed income security created to raise funds. Bonds can be raised through public issue or through the private placements. So the next type of long-term finance is the long-term loans given by the banks and given by the commercial banks. So the primary role of commercial banks is to cater to the short-term requirements of the industry. But of late, the banks have started taking an interest in the long-term and medium-term loans also. So the bank provides long-term loans for the purpose of expansion or setting up of new units. Their repayment is usually scheduled over a longer period. As part of the long-term funding for a company, the bank also funds the long-term working capital requirement of the company. It is funding of that portion of working capital which is always required and is not impacted by the seasonal requirement of the company. So the next long-term source would be venture capital. So what is venture capital? It refers to the financing of new high-risky ventures promoted by the qualified entrepreneurs who lack experience and also funds to give shape to their and entrepreneurial ideas. In broad sense, under venture capital financing, venture capitalists make investment to purchase the equity or the debt securities from the entrepreneurs who undertake highly risky ventures with potential to succeed in future. So the next long-term finance will be lease financing. Well, it is a general contract between the owner of the assets and the user of the asset over a specific period. The owner of the asset will be called as lessor and the user will be called as a lessee. So, the lessee will pay a specified rent at the periodical intervals for the use of the asset. Thus, leasing is an alternative to the purchase of an asset out of own or borrowed funds. Moreover, lease finance can be arranged much faster as compared to the term loans from the financial institutions. Now, we shall go into the short-term finance. Short-term finance, the first one would be trade credit. So what is trade credit? It represents the credit granted by the supplier of goods as an incident of sale. The usual duration of such credit would be 15 to 90 days. It generates automatically in the course of business and is common to almost all business operations. It can be in the form of an open account or in the form of bills payable. Next is advances from customers. Manufacturers and contractors engaged in producing or constructing costly goods involves considerable length of manufacturing or construction time, usually demand advance money from their customers at the time of accepting their orders for executing the contracts or for the supplying of the goods. This is the cost-free source of finance and it is really useful for the manufacturers and the contractors. Next is commercial paper. Commercial paper is an unsecured money market instrument issued in the form of a promissory note. The RBI introduced the commercial bank scheme in the year 1989 with a view to enabling high-rated corporate borrowers to diversify their source of short-term borrowings and to provide an additional instrument to the investors. Next would be treasury bills. Treasury bills are a class of central government securities. So treasury bills, commonly referred to as T-bills, are issued by the Government of India to meet the short-term borrowing requirements with maturities ranging from 14 days to 364 days. Next would be certificate of deposit. A certificate of deposit is basically a savings certificate with a fixed maturity date of not less than 15 days up to a maximum of 1 year. Next would be bank advances. Bank receives deposits from the public for different periods at varying rates of interest. These funds are invested and lent in such a manner that is required by the customers. So lending results in gross revenues out of which costs such as interest on deposits, administration costs are met by the banks. A bank's lending policy is not merely profit motivated but also to keep in mind the socio-economic development of a country. The next short-term finance source will be overdraft. So this facility is given to the customers who is having current account. A fixed limit is therefore granted to the borrower within which the borrower is allowed to overdraw his account. Though overdrafts are repayable on demand, they generally continue for long periods by annual renewals of the limits. Next would be bills discounted. Under this head, banks gives advances against the security of bills which may be clean or documentary. Bills are sometimes purchased from the approved customers in whose favor limits are sanctioned. So before granting a limit, the banker satisfies himself as to the creditworthiness of the drawer. Although the term bills purchased gives the impression that the bank becomes the owner or the purchase of such bills. In actual practice, the bank holds the bills only as security for the advance. The bank, in addition to the rights against the parties liable on the bills, can also exercise pledge rights over the goods covered by the documents. So these are the various sources of finance, that is both long-term and the short-term sources of finance. So in this lecture, I have covered the meaning of financial management, definition, basic aspects, objectives, functions of financial management, and the different sources of financial management. Thank you.